Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 11th of July. Markets have been making some fairly laboured progress over the last week. Obviously, the twin concerns of rising interest rates and inflation remain very much in play, and it seems pretty much nailed on that the July meeting of the Federal Reserve is going to result in another hike of 0.75%. That being said, there have been a couple of comments from Federal Reserve members, one of which was that recession fears were overblown. Another one said that the possibility of a soft landing actually came with a good chance, and that was enough to give something of a fillip to markets in the latter part of the week, especially the more beleaguered Nasdaq index, where growth stocks have taken a hit on the basis of a future rising interest rate environment. Of course, in the UK, there are other factors at play. Political machinations will lead to the debate as to whether government policy will actually change in terms of trying to revive the UK economy. And indeed, the FTSE 250, which is seen as a barometer for the UK economy, remains down by 20% in the year to date. In terms of the other major indices in the year to date, the Dow Jones is currently down 14%, S&P 500 down 18%, Nasdaq, despite the recent bounce, still down 26%, and the FTSE 100 down by 2.8%. Turning to next week, a couple of companies to look out for. First one is a trading statement from the house builder Barratt Developments. As we saw with Persimmon this week, it's likely that the disconnect continues between actual trading performance and share price performance. Barratt's are down around 34% over the last year. This is despite the last time we heard from Barratt's in May. They said that their forward sales were up by 18%, net reservations per week were up by 12%. They had net cash of £735 million and a fairly generous dividend yield, to say the least, of 7.2%. But overhanging the sector, of course, there's been the winding down of the Help to Buy scheme, the end of the stamp duty holiday, the cost of living crisis, and conflicting surveys suggesting that house price growth may be slowing. That's enough to have put a down on the sector as a whole. Also, some Q1 numbers due from Burberry next week. Shares down 17% over the last year, still suffering from the yet to full return of Asian tourism, especially in Europe, which has punched something of a hole through revenues. That being said, when we last heard from them at the full year, they had made some progress. The simple aim for Burberry is for the brand to be appealing, relevant and unashamedly high-end. They're very much concentrating on full price sales at the moment. As I say, the pressure on general retailers has been weighing down on the share price. Yield of 2.9%, which is fairly respectable given the current interest rate environment, and at those full-year numbers they also announced a £400 million share buyback, which should lend some support at least to the share price. Thank you for watching. Have a great week.